This year, we are very delighted to have two speakers from outside agencies to join us. The first speaker is Beth Redding from Bartel Associates. I'm sure many of you already know Beth, but in case you don't, she is the Vice President from Bartel Associates. With over 30 years in employee benefits, Beth has served as retirement consultant for a wide range of public agencies, specializing in pension and retiree medical benefits. Beth focuses on understanding benefit programs and clearly communicating long and short-term considerations so clients can make the best decisions possible for their organizations. Most recently, Beth has been involved with helping California public agencies, including CalPERS, cost-sharing plans, implement GASB Statement 68 and beginning implementing Statement 75. She speaks on current topics including CalPERS contribution rates and supplemental pension trusts, and as well as the new GASB accounting rules to retirement boards, city councils, boards of directors, and employee and professional groups. Beth also writes for Bartel Associates website. She is a fellow of she's a fellow of Society of Actuaries, member of the American Academy of Actuaries, fellow of the Conference of Consulting Actuaries, and enrolled actuary under ERISA. She earned a Bachelor's of Science degree in Geology and Geophysics from Yale University. With that, please help me welcome Beth.
Thank you, Kathleen. I'm really happy to be here today. I was on vacation last week back east, and you'd be kind of surprised to know it was cold and rainy the whole time, so I'm really happy to be back and see the sun. And especially back to here, I'm happy to be back here talking to you all about hopefully the sort of exciting GASB 74 and 75 rules that are coming up, or at least hopefully you'll find them interesting and not terrifying. So I have a really long list of things to talk about in the presentation. It's only an hour. I'm going to try to go through the things that I think are most important and spend a little more time on them. And so some things I'll go through really quickly, but they're in the handout if you want to go back to them later and reference them. So the first thing wasn't in the title, but I do want to talk about GASB 73 because that's actually effective now. It's for fiscal years ending June 30th of 17. And it's sort of a sleeper thing. Nobody's paying very much attention to it. It's about unfunded pension plans. And so those are pension plans that are not pre-funded. And it's very much like GASB 68. So all the reporting's the same. You have the same pension expense issues. But they're for plans that aren't funded. So the question is, what kind of plans are these? Because most people think they don't have any. And probably you're right if you think you don't have one. The most common type of unfunded plan that people have is the CalPERS Replacement Benefit Fund, or the replacement benefit. You'll know that you have retirees getting these benefits if you get a bill from CalPERS every year for these benefits. These are people who used to work for you and now have a pension benefit over the IRS limits. Those plans cannot be funded under the IRS rules. So even though CalPERS is administering them, they have to send you a bill every year so that they can pay the retirees out their benefits. So you'll know if you have retirees getting these benefits. What you don't know is if any people who've left you and have gone to work somewhere else are eventually going to get these benefits. You really can't track them. CalPERS, I think, knows who the people are, but as far as we can tell, they're not releasing any data. So this is sort of difficult because you may have this liability. Likely it's very small and not material, but you never know. So it's something you might want to talk about with your auditors. It's most likely to be important if you're a very small agency and you have somebody getting a very large CalPERS replacement benefit, but we think that's going to be really rare. What I have seen lately are some other plans that people didn't really realize they had. We talked to a client the other day and they just happened to mention that they had negotiated with one of their unions that when they had a final average 3 benefit from CalPERS, they had negotiated for various reasons with the union that when people retired, the agency would pay the difference between a final average 1-year benefit and the final average 3 they were getting from CalPERS. That's an unfunded pension plan and is subject to reporting under GASB 73, and that sort of thing is a lot more likely to be material. And it was something no one had ever really given any thought to. It's just something you bargained and you paid the benefits, but that's the kind of thing that would fall under Statement 73. So just like 78, you have to report pension expense, you get a net pension liability, you have to deal with deferred outflows and inflows. You're going to fund it at report it using the AA bond rate as a discount rate. Okay, so that's all we're going to talk about 73, but you probably do want to think through any arrangements you have to see if there's something that might be some sort of pension plan. Okay, ready for 74? 74 is also effective June 30th of 17. It's much like GASB 67, and probably nobody reported anything under 67 because you're all in CalPERS. And so CalPERS took care of that. 74 is for OPEB plans, and it's for the plans themselves, and it only applies to plans that are funded. So if you're not funding your OPEB benefits, this is never going to apply to you. If you are funding, whether or not you need to report on the plan's behalf probably depends a lot on where exactly you've put that money. So there's 2 places you could report. You could issue separate standalone financial statements for the OPEB plan. That's really, really uncommon. You could be reporting them as a fiduciary fund in your own financial statements. 3 types of plans. These are the same as pension, right? There's single employer plans. That's where you do everything. You determine the benefits. You determine where it's funded. You've probably set up your own trust. And all it has is money for your plan. There's agent multiple employer plans where the money is pooled for investment, but each plan, the money is separately allocated. It can only belong to one employer, even though it's pooled for investments. And then there's cost-sharing plans where the money is shared among everybody. For OPEB, I can think of a couple examples of cost-sharing OPEB plans, which would be the county systems. But other than that, I think it's unlikely there's any cost-sharing OPEB plans. So we might have agent plans. We probably have single employer plans. GASB 74 actually defines what a plan is. Never happened before. It's sort of as you would think. The plan is the arrangement through which the benefits are determined, through which the assets are managed, and the benefits are paid as they come due. And so unlike pensions, it seems to me that OPEB, in a lot of cases, we have those 3 things split among different entities. Likely that if you're funding, the thing that's managing the assets is managing the assets, but they're not having anything to do with determining what the OPEB benefits are. That's probably done by the agency, by the employer. And benefits paid as they come due most typically are being paid by the employer. Often they're not going through the trust assets at all, but they could be. So you could have these things in various hands. So the question is, are you a single employer plan or an agent plan? What makes the difference? And the answer is, I don't really know. Because it's not clear to me, but I'm an actuary, I'm not an accountant, so it's not my call. For people funding with CERBT, CalPERS has determined that that is an agent multiple employer plan. CalPERS is reporting as an agent multiple employer plan under Statement 74. They started last year. They're going to continue that this year. So if you believe them and your auditor believes them, that means your OPEB benefits, if you're funding through CERBT, are in an agent multiple employer plan, and you as the employer or the plan sponsor have no reporting responsibility under Statement 74, which is great. All you have to do is, I think CERBT is writing to everybody and asking for head counts, and that's all they want. If you're funding with PARs, PFM, other entities, I don't really know the answer. I'm not sure anyone knows the answer yet of whether it's an agent plan or a single plan. So the real thing to do is definitely sit down, talk to your auditor, see whether they think there's any reporting requirement under Statement 74. If there is, it'll kick in June 30th of 17, so you need to do it right now. Okay, let's skip what has to be reported. Okay, so now on to the big one, which is Statement 75. This is about employer reporting for OPEB plans, and it's effective for years beginning after June 15th of 2017, so 6/30/18. You can early implement this. Is anyone here adopting 75 for this year, 6/30/17? One in the back, only one. Okay. We have a couple clients that are starting this June, but I think it's still fairly uncommon. And we did have a few clients we work with who started in earlier years, a couple years ago, but most people are waiting until June 30th of 18. So this will replace GASB Statement 45. It's very similar to 68. So with that, I kind of feel like I could stop the presentation here, right? Because you guys all are really up on 68 and you don't need to know 75? No? Okay, good. We'll review. But the statements themselves, if you took your copy of 68 and you changed everywhere it said pension to OPEB, you would pretty much have Statement 75. The rules are very, very similar, which is good. You don't need to learn new things. The biggest thing to remember is that if you're not funding your OPEB plan, Statement 75 does not say you have to. It tells what to do if you're funding, but it does not require funding. Okay. So let's go back. What are OPEB benefits that are covered in this Statement 75? Well, most commonly they're health care. Most commonly they're health care provided to your retirees. And that also includes dental, vision, hearing benefits. Medicare B premium reimbursements is an OPEB benefit. Now you get to the trickier ones. There's three more things that could be OPEB if they're not provided through a pension plan. One is life insurance. So as part of your CalPERS pension benefits, there's a death benefit, right? That does not count as OPEB because it's inside a pension plan. But if you have a standalone retiree life insurance plan, not through CalPERS, that will become an OPEB benefit. Similarly, if you provide disability benefits through funding them yourself, not through the CalPERS pension plan, that could be OPEB, and also long-term care. That's a lot less common. The things that are never OPEB benefits are things that fall into the classification of termination benefits. These are things that you pay out upon termination to people, like cashing out vacation and sick leave. Severance, if you paid some sort of severance, that would not be OPEB. Everyone's trying to get rid of OPEB liability, and one way they're trying to do it is to change the way benefits are offered to people and trying to fall into a defined contribution plan. So I think it's really helpful to look at the rules and say, what's a defined contribution plan and what's a defined benefit plan? Because what you really don't want to do is restructure your whole OPEB program and then find out you didn't do it right and you're still a defined benefit plan. Okay. So what does it take to be a defined contribution OPEB plan? And I should say that if you're defined contribution, you don't need to do any of this stuff in GASB 75, you just report the contributions you've paid. Okay, so if you want to go that way, there's a big payoff. So to be defined contribution, you have to have an individual account for each member, okay, where you keep track of what each person has. The employer contributions can only go to active employees. They can't go to retirees. And there has to be a definition that's documented that says what this is going to be. So everybody gets $200 a month into their account or 5% of pay or something like that. Once a person retires, their entire OPEB benefit has to be only the amount that was in the account. So whatever the account grew to from your contributions and earnings, actual interest earnings on that account is what they get. So there can't be anything that says, if there's a shortfall, we'll give you extra at retirement, or if there was a big asset loss right before you retired, we'll make it up to you. They can only get what was in the account. Okay. So a defined benefit plan is everything that's not defined contribution. So if you have a guaranteed interest rate or a minimum balance on those accounts, it's not a defined contribution plan anymore, it's a defined benefit. The one interesting one is if you let people convert sick leave at retirement, if you take sick leave and convert it to dollars and put it in an account, that can be defined contribution. If you convert sick leave to benefits, so if you say for every month of unused sick leave, you can have 2 months of coverage in our OPEB plan, so you're converting it to benefits, that's a defined benefit plan. So you want to be really careful when you structure these things if your goal is to get out of the GASB 75 defined benefit realm. Okay. So going back to Statement 75 a little bit, Statement 75 defines this thing called net OPEB liability. We're all going to abbreviate it NOL. It's the OPEB liability minus the assets. Very much the same way we have net pension liability on the pension side. We think that this may not be a little number. This may be a big number. It may be as big as net pension liability. I went to see a small special agency about 2 weeks ago. They're very small. They have very good OPEB benefits. They pay the full premium for the employee and the spouse and dental and vision in addition to medical. Their net pension liability was $4 million. They've never funded their OPEB benefits. Their net OPEB liability is $12 million, 3 times as big as their pension liability. Right, so depending on whether you're funding or not and what kind of OPEB benefits you are providing, this can be a very big number. So you probably want to start thinking about how you're going to communicate this to people who look at your financial statements. Because we think it's not a lot of news to people like bond analysts. That information was always there in your footnotes, but was never up front, and it may be a lot more surprising to your city councils and your boards of directors and maybe your taxpayers. Okay, just like pensions, we have OPEB expense under Statement 75, and this, I think, is the hardest part of Statement 75. It's getting used to the fact that what expense is no longer the contribution. So you just have to let go of that. And I like to go back to the beginning, and the sort of root of this is that the change in the net OPEB liability from one year to the next, that should be the OPEB expense. That's the way the statement was designed. And I have a little footnote minus the employer contribution. So if you subtract out the employer contribution, the change in OPEB liability from one year to the next would be your OPEB expense. And this is just the way pension expense works. But the GASB said, well, if we do this, it's going to mean that OPEB expense fluctuates a lot from year to year. Some years it'll go up, some years it'll go down. It'll depend on a lot of things. And we think that's not very good for people. Personally, I'm not sure who they were talking to because most of the agencies I work with really don't care what OPEB expense is. They care what their cash contribution is. But the GASB thought it would be a problem. So what they said was, we're going to look at the causes of the net OPEB liability going up and down, and some things we're not going to put through expense right away. We're going to hold them out and recognize them over time. And those are what your deferred inflows and outflows are, and the reason they do that is sort of meant to minimize OPEB expense fluctuations. In reality, they make everybody's life a lot more complicated. Okay. So OPEB expense, I gave you sort of the root of it. The way actuaries calculate it and the way you'll see it in your OPEB reports from your actuaries is this whole list of different components that get added up together to make expense. There's the cost of benefits being earned during the year, there's interest minus return on assets, there's admin expenses, And then there's recognition of various things that you've deferred. People who are not actuaries don't calculate expense that way, and they calculate it like this. I don't want to go through this whole chart, but really what we're doing is we're saying, what was the change in net OPEB liability from year to year? From that, I should subtract out the contributions, because that's not part of expense. And then I should subtract out the change in my deferred inflows and outflows, because that's sort of the things that are not going through expense. And the difference is my OPEB expense. And this was a new accounting term I learned about a year ago. It's called a plug. And you guys know that, right? Because you're laughing. I didn't know that. Actuaries say we back into things. But it's the same thing. So this is a different way of looking at expense. This is a way I'm sure that almost everybody is going to calculate it, except for the actuaries. But you and the actuaries should get the same answer if you do it this way versus the actuary's way of looking at it as a series of components that add up to the same number. And when I do my calculations for people, I check to make sure that both of those add up the same. Okay. Last things about Statement 75, they talk a lot about paragraph 4, are you funded through a trust? So again, to determine what you're reporting, you need to figure out what kind of plan you are. I think just about everybody is going to be a single employer or an agent multiple employer plan, and luckily the Statement 75 rules are exactly the same for both of them. If you were cost sharing, you would have different rules, but I don't think there's many of them. If you're not funded, there's, again, special rules I'll talk about later, but it's basically the same as being a single or agent plan. There's a couple special circumstances that the statement talks about a lot, which are if you have non-contributing entities or special funding situations, likely not going to apply. There's a great exception. If you read all the way through the statement and you get to the very end, it says, if you're an insured plan, you don't have to do anything under Statement 75. And you kind of get really excited and you say, yes, I buy healthcare insurance, I'm an insured plan. But no, that's not what they're talking about. They're talking about, did you find an insurance agency and pay them a whole lot of money, and in exchange, they are going to pay all your retiree healthcare benefits forever and ever? I know that some of those deals were done a long time ago. I don't think there's any insurers willing to do that now. It would take a lot of money, so don't get excited about the exception. It's not going to apply. Statement 75 has all the same notes and RSI that you're doing for your pension plan now, if you're an agent plan. The only difference is right now in pensions you show the sensitivity of the net pension liability to a 1% change in the discount rate. You're also going to show sensitivity to 1% change in the healthcare trend rate. Actuarially determined contribution. This is actually kind of interesting. Under Statement 45, we had the ARC, the annual required contribution that was not at all required. Okay. Statement 75 has realized that the accounting board has no business telling people what a required OPEB contribution is. So they've done away with that term, and they've introduced actuarially determined contribution, which is pretty much any number that you and your actuary feel like is a good number. It's disclosed in the RSI. So just like for pensions, there's a little statement that says, here's what the actuarially determined contribution was, here's what we paid, here's the difference. But it's interesting. First of all, if you're not funding your plan, you don't calculate that number and you don't report it, which kind of makes sense because when you think about the calculation of the actuarially determined contribution, there's an assumption that you're going to be investing, that you're going to be funding and investing it, but if you're not funding, how could that happen? But secondly, it's only reported if the actuary has calculated it. So if you might have assets, but not be funding on a regular basis, you might have had some money somewhere and you put it in CERBT and you're thinking, okay, that's getting me started and someday I'll put some more money in there. In that situation, you might ask your actuary not to calculate an actuarially determined contribution because you have no intention of funding it. It costs some money to have them do the calculation, so Don't have them do it, and then you don't have to report it. Okay. That's my background on statement 70. We did 73 really quickly, 74 really quickly, and 75. I want to stop here for questions if there are any so far. It's kind of amazing. Okay. I'm going to go through then and hit some of the, I think, the trickier points. The biggest one people have a lot of trouble with is all the dates that are going on in 75. They're a lot like the GASB 68 setup of the valuation date, the measurement date, and the reporting date or implementation date. But here you have a choice, and with CalPERS you didn't have a choice. So I'm going to talk through some of the timing and tell you what we're recommending to people. Okay. So the first is this concept of measurement date. It's the date where you measure things. Okay, obviously, it's called measurement date. You measure things there. What do you measure on the measurement date? You measure the value of plan assets. Okay, so if you're funding, that's the day you're going to look at your bank statement or your trust statement and say, how much money do I have? If you're not funding, on the measurement date, you're going to pull out your newspaper and say, what are the AA municipal bond rates today? So you're going to pick that as of the measurement date. That's the two things that happen on the measurement date. You're also going to measure the total OPEB liability, the actuarial value of the liabilities. But even though they're measured on that date, they might not be calculated on that date. They're probably going to be rolled forward from a different valuation date. So they'll be rolled forward from an actuarial valuation date with no adjustments made if you didn't do anything significant to your plan. On the measurement date, they'll be compared to the value of plan assets, and you'll calculate the net OPEB liability. Whatever you get on the measurement date, you use at the fiscal year end, which can be any time up to a year later, and you will make no adjustments at all for any reason to that net OPEB liability. So it's almost like you pretend that the measurement date is your fiscal year end date. Okay, everyone good with that? That's a really key concept. Generally, we recommend picking as your measurement date 1 year before the end of the fiscal year. So for example, if everyone's going to implement Statement 75 on June 30th of 18, we would recommend that you pick June 30th of 17 as your measurement date. And there's a couple reasons to do this. One is it's the same timing CalPERS is using, so everyone, I might not want to say understands it, but everyone knows how to deal with CalPERS's timing, so you'll be using the same timing for OPEB, and that'll make sense to people. The other more important reason is it allows everything to be done well before the end of the fiscal year. OPEB actuaries work a little bit faster than CalPERS. We can turn reports around a little bit faster, but this still should get things done and give you enough lead time, let your auditors do their work on the numbers and not have some huge crush at the end of the year. The one exception to that recommendation, I would say, is if you're reporting under Statement 74. So you have a trust, likely not in CRBT, may or may not be PARS or some other agency. Let's say you've set up your own trust you're running yourself. You'll have to report under Statement 74. Statement 74 does not have the whole measurement date concept. You have to do everything as of the fiscal year. And in that one case, we would say it's probably better to use your measurement date as the last day of the fiscal year. It'll avoid having you do two full sets of footnotes with different numbers reported as of the same date. The actuarial valuation date, I told you it's not the measurement date. It can be up to 2.5 years before the end of the fiscal year. That's the date. What is the valuation date? The way I think about it is it's the date where you collect the participant information. So that's where we figure out how many employees you have, how many retirees you have, what does their census data look like. And that'll be the valuation date. The interesting thing is you don't have to do it on June 30th anymore. CERBT is not going to require that you turn in a June 30th valuation date report. They just want it somewhere near the right date. They're not reporting liabilities anymore, so they don't need those all on the same date. It could be easier to get data that you need, not on June 30th. You might consider a January 1st. It might be a good date depending on your renewal timing. But talk to your auditor, talk to your actuary about what might be a good date. Cool. Okay, so how does the timing work out? I'm going to work through a couple examples of what kind of timing you could get depending on what measurement dates you choose. So first of all, if we think there's no GASB 74 reporting involved, you would have a choice of implementation dates, either June 30th of 17 or June 30th of 18. Let's say you pick June 30th of 18, because most people are going to do that. Probably you'll pick one of two measurement dates. Probably you'll pick either June 30th 18 or June 30th 17. You could pick any date in the middle. If you're funding with CERBT, the only date you're going to be able to get audited assets is a June 30th. Okay? If you're not funding with CERBT, you might be able to pick other dates in the middle as your measurement date, but with CERBT, you pretty much have to be on a June 30th. Okay. If you were implementing June 30th of 17, you'd have the same dates possibilities, only a year earlier. But let's just think about 18. Okay, so if I want to use the recommended measurement date of June 30th of 17 for a June 30th of 18 fiscal year end, my actuarial valuation date, the date I collect census data, can be anywhere up to 2.5 years before the end of the fiscal year, so anywhere between January 1st of 16 and June 30th of 17. It can't be after my measurement date. It just doesn't work. Okay, so when is the valuation going to be done? If I'd use a January 1st, 16 valuation date, so the very earliest possible, and I, as the actuary, get census data from you on a timely basis, I can probably turn around an initial valuation report by, let's say, May 1st of 2016. Give me 4 months to do it. But that's not really done because remember, we need to roll it forward to the measurement date. We need to pick up either assets or the municipal bond rate at the measurement date, which is June 30th of 17. So probably the very earliest the actual report could be done is August 15th, let's say mid-August of 2017, probably a little bit later. But remember, once that's done, you can give it to your auditors. You're all set for your June 30th of 18 financial statements. So it's done well before the end of the fiscal year. If you used, instead, let's say you went to the last possible date for your actuarial valuation, you asked for June 30th of 17, probably the valuation would be done maybe end of October, depending on, again, on how quickly census data went back and forth. Is it clean? And in that case, it would already be after the measurement date. You would already know the assets and the municipal bond rate, so your GASB 68 reporting would probably be done about the end of October. It's a few months later than if you did the early valuation, but it's well before the end of the fiscal year. You have a lot of time to look at it, think about it, talk to your auditors, do your testing, whatever needs to be done. If, on the other hand, you went to a June 30th of 18 measurement date, you could still have the early valuation January 1st of 16, but you have to wait till the measurement date to pick up your assets. Your report's going to be done earliest August of 18, so after the end of the fiscal year. If you don't even do your valuation until June 30th of 18, you might get answers back in, let's say, October of 18, maybe not, probably later. The one issue I haven't written about here is if you're with CERBT, do you want to use the asset statement you get every June from them? Sorry, July, with your June 30th numbers, July, August. That's sort of what I assumed in this timing. They've said they're going to issue some sort of audited statements of everybody's CERBT pieces, and they'll probably be posting those in the fall. So the one thing that could sort of hold up these schedules, if you decide you want to wait to see what the audited asset statements say, you might have to slide everything back a little bit. We don't know yet if there's expected to be any differences between the monthly statements you get and the audited statements. I would think it would be small, if anything. But this timing kind of shows why we recommend the earlier measurement date, because you can get stuff done before the end of the fiscal year, even if you had to wait another month or two. You were first.
We actually do have a GASB 74, we have a trust.
Okay.
Am I misunderstanding, or I don't think I'm understanding? If we had financial statements last year for the trust,
Right.
for the OPEB trust, would we have to use, are we locked into using like a 6/30/18 measurement date?
Okay. So you're a county, you have your own trust.
Right.
You're the exception I was talking about. Okay, so let's think about it. Let's think about June 30th of 18. For June 30th of 18, you need to report under GASB 74 for the trust, right? And that is going to give you the net OPEB liability right on June 30th of 18, okay? You're going to measure the assets June 30th of 18 and the liabilities June 30th of 18. If instead, so 74 is clear, you have no choices, okay? 75 is the issue. Let's say you wanted to use, can I go back and just show? Let's look at just the June 30th of 17 measurement date column. If you want to use for 75 a 2017 measurement date, you're going to be reporting your net OPEB liability that you measured in 2017. You're going to do all those footnotes. You're going to put them in your financial statements and label them 2018. And you know what? It's going to be a different number than you got actually at 2018. It can't be the same number. So you're going to have a set of GASB 74 footnotes with one number and a set of GASB 75 footnotes with another number. And it's going to be long and confusing. So if instead you pick 2018 as your GASB 75 measurement date, then all the numbers will be the same. A lot of the notes will be duplicating each other, and you won't have to have, you can get rid of a lot of them.
Right, and if you show them, because the two gap,
Yeah.
we could still do 815, I get you. Okay.
Yeah,
That
and
makes sense.
you have to wait to finish 74 anyways, so there's like not a lot more work to do 75 once you're doing 74. Okay,
No, perfect. Thank you.
sure.
I was just wondering, are these valuations good for one capper, or are they good for two cappers, how the GASB 45 work?
Okay, so the rule on the valuation date is it has to be within 2.5 years of the end of your fiscal year. So basically you get 2. You might be able to work it to get 3, but it's all about the timing relative to the end of the year versus how many times you can use it. You cannot get, if you were a small plan under GASB 45, you could get 3 years out of your valuation and that one's gone. It's just back to the timing rule. Other questions? Okay. I'll talk a little bit about data. This was my initial thought on GASB 75, that the audit issues would be way fewer than 68 because employers control the data. It's not all in the hands of CalPERS. But now I think the audit issues are probably more because employers control the data and it's not in the hands of CalPERS. When you think about it, CalPERS has, they have this whole building in Sacramento, right? And it's full of people who administer your pension plan, and they know all the rules, and they're all written down, and they know all about everybody who's covered and not covered and what they're getting, and everything is standardized. When you think about your OPEB plan, it's not. It's run by you, the employers. How good is your record keeping? How good is finance at talking to HR and talking to the people who negotiate the benefits? A lot of that, I think, causes a lot of issues. There's a lot of things that really aren't well known. I'm going to try to highlight a couple of those things as we go through. OPEB, like pension, runs on the substantive plan. Particularly for OPEB, things aren't always written down. You probably don't have a shelf full of binders that talks about the OPEB benefits. So we're trying to figure out what's the plan as it's understood by the employers and the employees. When I'm doing valuations, I look a lot at the MOUs to tell me what actually has been negotiated. But a lot of times, you read the MOUs and it's not clear, and you talk to HR and it's not clear to them, and sometimes you talk to the negotiating team and they say, oh, we never thought about that. I'm not sure what was intended here. So it can be really hard to figure out what the benefits are. You're going to look at any communications with employees and retirees. It's generally, the issues you run into are, for people who've already retired, you know what they're getting paid, but there may not be a lot of documentation around that. You have a lot of old agreements. You may have agreements with, I don't know what to say other than special people. We had a deal with the city manager that when he retired, he would get this, and his spouse would get that, and his kids would get this. And nobody else gets that deal. And it may not be written down, really. The other issues are among new benefits. We just negotiated that new employees would get no benefits. Well, can they buy into the employer plan when they retire? We didn't think about it yet. They're not going to retire for another 20 years. So there's all these benefits that haven't come into play yet, so it may not be clear how they're meant to work. The one rule is that in terms of agreements and benefits you're negotiating, you're going to look to the agreements that were in effect at the end of the fiscal year. So anything that's been agreed to and negotiated on the end of your fiscal year is what you value for the OPEB liability. I guess I'd say the other thing about OPEB is that very much unlike CalPERS, every single agency we work with has a different plan. And they're all different, and you definitely can't assume that just because this was the deal where you used to work that your current employer has a similar arrangement. It's almost certainly not. Okay. So step one is sort of understanding what benefits you have, documenting them. But I'll wear my lawyer hat for about 10 seconds. Be really careful when you document that you don't write down things like, this is what we promise to give people forever and ever. OPEB is a lot less vested than pension, and it's sort of undetermined how vested it is, and you don't want to start publishing things on your employee website that inadvertently make benefits more vested than they were intended to be. So just be careful. Okay. The next thing you're going to have to do after you determine what the benefit is generate census data, and that census data will go to your actuary, and it will likely go to your auditor as well. So you have to make sure that you include everyone who benefits now and could possibly benefit in the future. So those include active employees who've waived benefits now because they could get back into the plan when they retire. If you have CalPERS healthcare benefits with PEMCA, people who retire can choose to elect back into that healthcare benefit later on. Generally they don't, but legally they're entitled to. It's not whether or not they take the benefit when they first retire. So it can be difficult figuring out all the people who are covered or who could possibly be covered. There's no data source. There's no one good data source. Again, if you're in CalPERS at PEMCA, you can get the data download. It may have extra people on it who don't belong to you. And if you're paying benefits sort of out of pocket in addition to the PEMCA premiums, there may be people who are covered who are not on the list. So it's not necessarily easy to put this data together. If you have life insurance and dental and medical separately, you may have totally separate groups of people that you need to provide a consolidated data file for. Okay, it's not easy. Okay, good. So what I would say is even if you're implementing June 30th, 18, it's not too early to start making sure you have good documentation of your plans and who's covered, because I think that's an underappreciated job, putting that together. Actuarial issues. I want to cover a few. The discount rate is different than GASB 45. We have something called a crossover test to determine what the discount rate is. This is new. It was in the pension rules, but CalPERS passed the crossover test, so nobody worried about it too much. OPEB is going to be really different. The way the crossover test works is we do a projection, as specified in the GASB statements, of what the plan assets are going to be going forward, just for current employees and retirees. And if the projection shows that there's enough money in the trust to cover all the projected benefits, then your discount rate is set equal to the rate of return on plan assets. If the test shows, well, let's start with the easy one first. If you're not funding, you're going to use the AA municipal bond rate. If the test shows that somewhere in the future you're probably going to run out of money in the trust, then you're using a discount rate somewhere in between. Okay? So the test isn't really, when I say we project things forward, we project future contributions going into the trust and benefits being paid out of the trust. So it's not so much how much money you have now, it's a lot more driven by what are your plans for future funding. Okay. If you're funding, I'm going to use the old ARC term, if you're paying the full ARC, your amortization period is closed, it's sort of 25-ish, 20 to 25-ish years, probably you're going to come out fine. If you've been paying, again, if you've been paying the full ARC. If you've not been paying the full ARC, your ARC is a 30-year rolling amortization level percent of pay, it may not come out so well. So the test, I think, will be interesting, and a lot of people will be falling in between. If your funding policy is, I've set up a trust, and whenever I have extra money, I put some in there, it's going to be a lot more difficult to pass and also a lot more difficult to document what your funding policy is and to do that projection. So this will take some work. I talked about this. The municipal bond rate is not specified by GASB. We track it on our website. I gave you a link here. We sort of pick it up every quarter. You can use any rate you think is good. The interesting thing about that rate is it's really volatile. Probably finance people know that. We've been tracking it since 2013, and it goes up and down a lot. This means that if you're not funding, your net OPEB liability is going to go up and down a lot just from the change in the discount rate. Okay. It was about 4.6%. The green numbers are the bond buyer 20 rate. In 2013, it was 4.6%. The low point was 2016, it was 2.85%. Now it's back up to about 3.5%. So you can see it can easily move 100 basis points in a year. And we're calculating present values. So this means when the discount rate goes down, the present values go up, your net OPEB liability goes up. I want to spend an extra minute on the rates because they're kind of interesting. I've tracked these 5 rates. We lost bonds online about 1.5 years ago. Bond buyer 20 used to be the most common rate that we saw people using, I think because the Federal Reserve picked it up in their interest rate publication. They stopped publishing that rate last fall. Bond buyer no longer gives you free subscriptions to their site. We've found that reported a couple places. We may lose it. So that's going to be a much less public index than in the past. S&P 500, I think you can still get this year's rate. You can't go to their site and find old rates unless you get a subscription. So I think the choice of what particular index people are using is going to be a lot, I don't know what to say, is probably going to be doing some shaking out over the next year or two. So you want to think about that when you pick a rate. They all go up and down a lot. I don't think there's any advantage to choosing one over another. But mostly just figure out, am I going to be able to get a hold of that rate next year? Okay. Talk a bit about pre-funding. So let me ask, how many people here are pre-funding their OPEB benefits? Some? How about who's not pre-funding? And a whole lot of people not raising their hand at all. Okay. There are way more people funding than not funding. Okay, so why should you fund? We'll talk about that first. As actuaries, we think you should fund because we think that it's just a really good thing to do. There's arguments about taxpayer equity, right? Who should pay for the benefits? It should be people who are benefiting from the service of the employees. It does, okay. try not to remember about what's happening to your CalPERS rates while I say this. It should give you a more manageable cost pattern over the life of the plan. For financial reporting, because if you're funding, I can use a higher discount rate, I can use the long-term rate of return on assets, that lowers the liability and lowers your net OPEB liability. And it demonstrates to your stakeholders that you understand you have this liability and you're doing something about it. What that really comes down to is that some of the benefits will be funded from investment earnings rather than strictly from taxpayer dollars. So all those are good reasons to pre-fund. When we look at our clients, we've been tracking all of the OPEB valuations we do. This is sort of a chart. The way it works is on the left, that tall column, that's 100% of the plans. The next bar, that's about 50%. That says those are the number of our plans that are over 10% funded. The next bar is the number over 20% funded. So if you look at all of our plans, the average plan is about 24% funded, but the median is about 14% funded. So it means half of the plans we work with as of 2 years ago are funding, so the median is 14. So it means that a little over half of the plans we work with are funding, at least to some extent. A little less than half of them are not funding. I find that really interesting. It's a little bit of a select group, right? It's the people who've had their actuaries telling them for a long time that they should be funding. But I think if you went out into the public, and particularly not in California, and asked how many agencies are funding OPEB benefits, it would be way, way less than 50%. So I think in California, we're actually doing some good work in starting to get these benefits funded. I think that GASB 75 will put more focus on the benefits, and if we were to do this study in 2 or 3 years, we'd see a lot more people funding. I can talk about the implied subsidy. I don't want to spend very long on it unless people want me to. This is pretty much just an issue for people in getting smiles. People getting their benefits through CalPERS in PEMCA. For a long time, the implied subsidy was not required. We believe it is required now. The implied subsidy is a benefit that retirees derive by having their premiums calculated in a blended rate with the active employees. So the active employees, the premium's too high. Retirees who have higher health care costs, their premium is too low. Overall, it's just right. But actuaries, since we are only looking at retirees, the time that we're concerned with is the time when the premiums are too low for the benefits. Okay. So what the actuarial standard said is we have to include the actual claims, the actual cost of benefits, rather than the premiums. They said if you're not with CalPERS, you had to follow these rules anyways. You always have. There's no change. Okay. What's the impact of this implied subsidy? This, I think, is going to be a lot more interesting and difficult. So first of all, if you've had this issue come up, you know that when I add the implied subsidy into the valuation, it increases the liabilities, and sometimes it increases them a lot. Okay. There's other places it affects the GASB 75 accounting, particularly if you have a trust like CERBT that you've been funding and you've not been paying benefits out of the trust. Okay. When you do the reconciliation of the net of the fiduciary net position, you have to include in that reconciliation benefit payments, even though they're not actually going in and out of the trust. The GASB wants those benefit payments there. Those benefit payments include the cash benefit payments plus the implied subsidy benefit payments. The extra you're paying for retirees that you should have paid if you were paying the full cost of their premiums. You don't know what that number is. Only your actuary knows what that number is, so they have to tell you. Okay. When you do the reconciliation of total OPEB liability, one of the lines there is benefit payments, and that has to include the implied subsidy benefit payment as well. When you do the crossover test, the implied subsidy has to be included in benefit payments, although there's some exceptions and sometimes it's not. So all those times you have to include the implied subsidy as well as the benefit payments. I think that's going to be difficult because you're probably used to looking at an asset statement and saying, oh, these are my benefit payments, and when I reconcile assets, I'm going to use those benefit payments. You're not. You're going to use some other number that the actuary told you. Similarly, most of the time, particularly if you just have a trust that's sitting there and you're running all the benefit payments through cash, the employer contribution will include that implied subsidy benefit payment. Okay, unless you're funding a true actuarial contribution. If your actuary tells you this is the actuarially determined contribution, you put that whole amount in the trust, then you probably won't add an extra for the implied subsidy. So it's going to be a little bit tricky and difficult to get used to at first. That was the hardest one. There's a couple other actuarial issues. Entry age is a required funding method. That may be a change for you, and it could make the costs go up or down. The actuaries have to include future mortality improvement. That's probably not new. There's a special thing in 75 about the Cadillac tax, the excise tax from the Affordable Care Act. A year and a half ago, I might have told you that that's definitely going to happen and we have to put it there. I have no clue right now. Nor does anyone else. But if you think that is going to come through and happen somehow, there probably needs to be some liability added for that. There's a specific bit of GASB 75 that talks about it. In terms of assumptions, the actuaries have to think about things that you may not be using for pensions that matter a lot, most particularly how many people are going to participate in your plan. If it costs them money to get the benefit, they may or may not decide to take the benefit. And so usually the actuaries will be looking at your particular experience and trying to estimate that number. Okay? Your auditors, I would expect, would be asking for some justification of where that number came from. It's really important. If I assume that 100% of people, that 50% of the people take the benefit, the liability I get is going to be half of what it would have been if I assumed 100%. And if I assume 10% of the people take the benefit, I'm going to get 10% of the liability. So it has a huge direct impact on the liability. You want to make sure it's a reasonable number. There's alternative measurement method that very small plans used to use. It still exists. You can do it if your auditor says you can do it. It's a lot more complicated than it used to be. So if you're using that, probably check with your auditors. I'm going to jump to the last bit because then we'll have time for questions. What should you get in your actuary's report? This is what I think should be there. Hopefully this will be in the report from your actuary, and then you'll have everything you need. The easy things are the net OPEB liability and a reconciliation of that. You should see expense. You should see your deferred inflows and outflows. You should see the sensitivities to the discount rate and trend. And you should see the implied subsidy benefit payments. All those things you'll need to do the reporting required under 75. The actuary should be telling you what the basis for the discount rate is, and if they did a crossover test, they should be telling you about that test. They may or may not actually give you the full pages of sort of spreadsheets of the test, but they should be telling you what they assumed for the rate of return on assets and what they assumed your future contributions were going to be. That really is the basis of that test. The report's going to, if it's funded, it's going to hinge on what are the long-term expected rate of return on plan assets. The actuary may make a decision. I personally prefer not to decide what that number should be because I'm not an investment person. I would rather have you guys tell me what it is. But there should be some discussion of what the long-term rate is and why you chose it, because that's the disclosure you have to report. There should be some rationale for the actuarial assumptions, an experience study date if there was one, because you're supposed to report it. And if you've asked for the actuarially determined contribution to be calculated, that'll be in the report. You need the expected average remaining service lifetime, summary plan provisions, the dates, and a certification. The actuary is probably not going to have your covered payroll. They're going to maybe know about the payroll of people you reported to them for the valuation, but that's not the covered payroll you need to put in your RSI. They're probably not going to give you journal entries. Maybe you don't want them to give you journal entries. It's not going to be like the cost-sharing plans for GASB 68. It should be okay. The other thing they're not going to have is the head counts. As you know, if you're in CERBT, they're asking you for the June 30th, 17 head counts right now. The valuation date was 2 years ago, likely, or a year ago. They're not going to have the fiscal year-end head counts, so you're going to have to come up with that yourself. Okay. Perfect timing. I'm up to questions. We've got about 5 minutes left, and hopefully we have questions. No. Unbelievable. Yes.
I have a question on the implicit subsidy. We keep putting money into the trust to cover that. Is it ever going to come out?
That's a good question. So the question is, if when I take into account the implied subsidy or the implicit subsidy, I add it into the liabilities, I add it into the required contribution, I tell you to put money in the trust for it, how does it come out? It comes out because it's added into the benefit payments. When you take the money out, you're going to pay cash benefit payments out of the trust. You could, I'm going to tell you what I think the implied subsidy benefit payments are, okay? You could reimburse yourself for that. So you could put money out of the trust and reimburse yourself for the implied subsidy benefit payments. Or you could just let it stay in the trust, and the trust will be more funded and it will reduce your future contribution requirements.
So then the money we draw out from the implicit subsidy, that's offsetting our active.
It's offsetting your actives.
Got it.
Right. And you can actually make accounting entries to show that offsetting payment where the actives are paying extra to cover the retirees. A lot of people think it's too small, but we think more people will be doing it.
Assuming there's no further discussion about implied subsidy, still one of my pet peeves, I'm assuming it's pretty much off the table, it is what it is. I guess I still,
All of, no,
I still like the old rule, I guess is what I guess was
Okay.
saying. I still like the old rule.
So Bartel Associates, which is my firm, and most but not all of the actuaries in California believe that it's a done deal. The GASB says it's a done deal. The Actuarial Standards Board says it's a done deal. They really believe the implied subsidy should be there, and they want it there. So we think it's a done deal, and as much as we think it might not be the right rule, it's the rule. Other questions? I think we're good. Well, thank you all very much. I've enjoyed talking to you. You've been a great group, and I think you all know a lot about 68 and 75, even if you don't think so.